Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. So this is one of the videos that we always do every single week where I share with you guys 5 companies that are still undervalued at this point in time. I'll give you some information about each one of the companies, and of course I'll, as always, do your research to find out more information about these companies, especially if you're interested. Of course, don't buy any of these companies because I've said so. You're going to have to go away and do your own research, inshaAllah. And of course, once you're comfortable, then you can look into potentially buying a little bit of these companies. All 5 of them are undervalued at this point in time based on Morningstar valuation. I will also show you what, when it comes to things like seeking alpha and so on, as saying in terms of the company. So let's get started. Before we do it, if you can join us in the Patreon account, it definitely helps the channel, so that will be absolutely amazing if you can join us. If not, just like the video, subscribe to the channel, of course, if you haven't already, and share with your family and friends. We're trying to reach out as many people as we possibly can and spread the word, especially when it comes to Sharia-compliant investing, inshallah. But before we do that, we'll just have a look at the S&P 500 and the Nasdaq, as well as the Dow Jones and the FTSE 100. A year to date, we are doing well. 13% for the S&P 500, 8% for almost 9% when it comes to Dow Jones. Nasdaq's about 18% up, FTSE 100 about 13% up. And when we look at just this month only, okay, it's more or less flat. The FTSE 100 is doing, but the rest of them are flat. Of course, because we've had a good days and bad days, and I think it's going to continue doing that for at least the next couple of weeks. Let's see how the markets go. Again, it's very difficult to predict these things. Here's the fear and greed index, and this sort of helps us to tells us what's the sentiment right now with regards to investing generally. We're talking about stock market, we're talking about crypto, whatever it is. And as you can see here, we are closer to extreme fear. So let's see where that goes in the next few weeks. But as always, we don't really care about these things. What we want to do is buy high quality companies, hold them for a very long time. And when I say very long time, I don't mean buying in and out of the market. It just of course, if you want to trim things, if you want to change things, and basically the sentiment has changed or your thesis have changed for specific companies, that's okay. But I'm talking about just buying today and then selling it tomorrow. That's not the things that we do. We're trying to hold some of these companies in this portfolio have been here over 5 years. This one has been over 5 years. This, I think, about 3 years. Visa over 5 years here now. So there's companies that this one, Home Depot, has been in my portfolio since I started the portfolio. So there are basically companies that I've had over 5 years now, and I'm planning to hold them for another 5 to 10 years, inshallah. And that's what you want to do. You just want to be consistent, inshallah. Okay, as always, I'm going to share with you guys similar sort of information. This one has every single one of these companies has a white moat. So the white moat companies are normally companies that have a sort of a protection against any other competitor within the market, so which is quite nice to see. And of course, we look at the dividend side of things. We're looking at the profit margins, return on equity, return on invested capital, just to kind of have an idea of how effective the management is. We want to see free cash flow. Free cash flow is money the company can use to reinvest into the business, if you like, to pay off any debt, pay dividends, if you like, buying back their own shares. They could do a lot with this money. And EPS growth expected for the next year. So we're just looking at 1 year into the future. Where is the company going to be? And then the same goes for revenue side of things. And then Morningstar valuation. I always use Morningstar valuation because I find it has a little bit of a margin of safety, and then top of that you can still have another 5, 10, 15% on margin of safety, depending on how volatile that stock. And the first company we're going to talk about today is Salesforce. I've been talking about this company. I genuinely think it's a high quality business, the one that probably I would be holding for a very long time. Is the leader when it comes to that CRM side of things, or customer relationship management software side of things. They're in the cloud side of things. They get into AI, the agentic AI, and so on. A lot of people think this company is done because they're going to lose a lot of business because AI is going to take over. Well, they are investing in that sector, so in that sort of AI, and trying to make their software better and automations and all of those things. So I don't think they're going to be out of business anytime soon. And it's one of those companies where, if you are the moat side of things, if you are if you already subscribe to their business, it's very difficult to move to any other company. So they've got that sort of a stickability, if you like. So let's see how things go. Anyway, when it comes to dividend, the company barely pays any dividends, and if we look at the basically year to date, it's down about 27%, and that's a lot. And when we look at Wall Street, for example, They are saying there's about 36 analysts that are saying it's a strong buy right now. We've got 8 buys, 12 holds, and 1 sell. And now if you look at the price, 36% upside from where we are, $331 per share is where they think the price should be. And as you can see, it's about 34% upside from where we are according to this one, 325, and this one is saying 331. So not much of a difference between the two, Morningstar valuation and Wall Street average. So great company, and right now it seems undervalued at this point in time. So it's one that I will definitely be looking into, researching more about if you don't own it. Of course, I'm not saying go away buy it right now blindly, but of course you're going to have to do your research. But a high quality business right now has 34% upside from where we are, with the sort of a market that we're dealing with right now where everything has gone to the moon. I would say it's a great place to buy this company right now. The next one is Relx. This is a company, it's British Dutch multinational that provides information based analytics and decision tools for professionals and business customers. It covers areas like scientific, technology side of it, or technical and medical information, legal and business analytics, risky and business intelligence, and so on. So they got a lot of type, really good business model, and their revenue is not just comes from one basically segment, if you like, and they have a wide moat. Right now it's 82 billion market cap, so these are all in dollars, although they are in the FTSE 100. Price right now is $45 per share. And as you can see here, they do actually pay a nice dividend. A profit margin, return on equity, return on invested capital, probably one of the best out there when it comes to free cash flow, $3 billion, which is nice to see. EPS growth for next year, they're expecting about 9%, revenue about 7%, which is really good. 15% upside from where we are. $52 per share is where they think the price should be. It's the one that I'm currently looking at. I'm going to do a little bit more research, inshallah. It's been on my radar for quite some time, but I haven't looked into more details, if you like. And right now, as you can see, a year to date is actually down. For the last 6 months, it's down about 13%. For the 1 month, it's down about 4%. And the last 5 days, just a tiny bit up. For 1 year, and 7% up. For the last 5 years, we're looking about over 100% up. So if you bought 1 year ago, right now you'll be over 100% up. And Wall Street thinks is basically strong buy right now. So if you look at this, actually, there's not that many people looking at. We got 3 people looking at this, 3 analysts right now. So 2 strong buys and 1 buy. And what is their price tag? So about 30% upside from where we are, $58 per share. This one is saying it's about $52 per share. 45 is where it's at right now. Again, it's a great company, potentially one I'm looking into, inshallah. So let's see how that goes. Another one that I've been talking about lately, automatic data processing, 8% upside from where we are. Great company, excellent business model. I've done a video recently, so if you want to watch that video, go watch that one. ADP, let's go and check out how much is actually down or up for the year to date. So we're using Seeking Alpha. Year to date, we're down about 4%, and for the 1 year, about 36%. But when you do last 5 years and so on, it's about 93% up, basically, and up. And the last 10 years, about over 200%. Wall Street is saying there's a hold right now. 2 strong buys, 0 buys, 12 holds, and 1 strong sell. But it still has about 11-12% upside from where we are, $314 per share. And right now, as you can see here, $281 per share. So it's about 8% upside from where we are. This is probably one of the best companies out there when it comes to dividend side of things. Is a dividend king, which means a company that has increased its dividend for 50 plus years. And that dividend is very safe right now, 97%, which is the highest any company can get. Profit margin, return equity, return invested capital. You will not find it. You'll not find it that many companies out there that has that sort of a matrix, if you like. And the free cash flow, we're looking at about over $4 billion, which is really good, and expected to grow the earnings about 10%, revenue about 6%. So let's see what happens with the company. But I think another one, and again, if you don't even want to, if you want to take a little bit, if you think like, okay, maybe I need 10% upside profit margin and so on, not profit margin, margin of safety, then the way the market is going right now, you might get that opportunity. So in the next couple of weeks, by this time next week, it might be down another 2-3%, whatever, and then that you will get your chance. Another one that I've talked about recently is Intuit. Great company, $661 per share right now. It has a white mode, of course. Great company when it comes to dividend side of things, when it comes to profitability side of things, how effective the management is, excellent free cash flow, expected to grow 15% in terms of EPS, revenue about 12%. Morningstar is saying 9% upside from where we are, $720 per share is where they think the price should be. And if we look in this company right now, if we look at the summary side of things, the year to date is actually up just 5%, when the S&P 500 is up about 13%. So it's lagging the overall markets. For the 1 year, it's actually only up about 9%. For the last 5 years, over almost at 100%. Last 10 years, we're looking at about 575%. Again, just the forward PE about 28 seems cheap for this type of business. And Wall Street is actually saying 19 strong buys, 6 buys, 7 holds, and 1 sell, and it's about 22% upside from where we are. This one is about 9% up, upside from where we are. So let's see how it goes. But I think it's another great company, one I'm also looking at. So these two are actually on my watch list now. If you want to get hold of on my watch list, join us at the Patreon account. I will be sharing that tomorrow or the day after, my updated watch list for the month of November and December, inshaAllah. That's something I share with the community on basically all the companies that I'm looking at and more, inshallah. For some of the community requests that I've got also, I include them in that watch list. So join us if you would like a copy of that. Next one is Linde. This is one of the companies that I've had in the portfolio a while ago. It was so overvalued at one point. Took some profit, sold it, and is now about 3% upside from where we are, $466 per share. When it comes to the dividend side of things, this is a dividend aristocrat. It's a company that have increased the dividend for 25 years and plus. You get that 1.3% in terms of dividend yield side of things. Payout ratio is quite low. Latest increase was 8%. The 5-year growth rate of 10%, which is really good. Annually, you get $6 and is very safe, 99%. That's the highest any company can get. Profit margin, return on equity, return on invested capital is decent. Free cash flow $5 billion. Revenue is expecting to grow about 9%. EPS about 9%. Revenue about 6%. 3% upside from where we are. $466 per share is where we are. So that's about 450 is where we are now as we speak. So let's have a look at this one in terms of where we are. Let's click summary. Year to date is down about 7%. No, so that's for the 1 year. Year to date is up about 8%, which is okay. Still lagging the overall S&P 500. Last 6 months is actually flat, and for the 1 month is down about 5%. But that's probably one of the reasons why I started looking at this company. And for the 1 year, about 7%. For the last 5 years, we're looking at about 96%. And what this is, by the way, just price appreciation. This is not total return. Is in the last 10 years 303%. Wall Street is currently saying 15 strong buys, 4 buys, 5 holds, and 1 strong sell, and it has about 13% upside from where we are. So that's another company that's still undervalued in my, basically according to the research, according to Morningstar and everybody else. Again, all of these companies are great companies. They're not very small companies. They're huge companies. Some of them. This is the smallest out of all 5 of them. All of them have a wide moat. And with regards to the dividend side of things, they all pay dividends. Although some of them are dividend kings, some of them are dividend aristocrats. Excellent free cash flow. All of them have excellent free cash flow, which is really good. From 5 billion, 6 billion, 4 billion, 3 billion, 12 billion dollars, which is absolutely amazing. Especially this one here. Their free cash flow growth in the last few years has been absolutely amazing. If we actually go in here and see the free cash flow margin of 32%, which is absolutely beautiful to see. So yeah, overall, great companies, all of them. Let's go into the Sharia-compliant side of things. Okay, no issues with so whatsoever. You might find other websites where they have these 2 companies, okay, and say basically they're not Sharia compliant. Again, not this one, these 2 here. And again, Allah knows best, okay. But according to the standards that Zoya uses, which is basically the standards that I've read page to page, which is huge document, okay, they are Sharia compliant. And the bit they say this not Sharia compliant is the business side of it, whereas Zoya has a 98% and 99%. And when you look at their business models, I've not seen anything in their revenue side of things that flags out anything that's not Sharia compliant. So again, it's your decision, of course. You basically do what you need to do your research. But according to Zoya, according to the standards that everybody should be using, okay, this is the standards a lot of the Sharia compliant scholars and so on has come up with from different countries, and all of that's been agreed. Based on that is these companies are Sharia compliant. So I feel confident and comfortable enough to buy them, but of course you're going to have to make your own decision with that one. Anyway, I'm going to stop the video here. I hope you can join us to the Patreon account. It genuinely makes huge difference. And again, I haven't actually talked about this for a while. So now I've actually managed to finish all the requests that I've had from basically from the community. So from now on, if you join us in this intelligent investor section, the subscriber portfolio reviews, download the file and then fill it in and tell me your details about your stocks that you own and so on, and then inshallah I will give you my honest opinion and I'll give you a feedback. Hopefully that's going to help you inshallah in the long run, and I'm just genuinely going to be honest with you guys and tell you exactly what I will be doing if I was in your shoes. Of course I'm not a financial advisor, but based on what I've done, based on the things that I own and so on, I can tell you some of these from basically some information that inshallah potentially can help you. Anyway, I'm going to stop the video here. Have a wonderful day. Assalamu Alaikum.